Good morning, this is Larry McMillan with a stock market update on Monday, April 4th, before the market opens. So last week we saw the S&P 500 break out over 4,600. In fact, it did so on a gap move. It seemed like things were in pretty good shape, and then it quickly reversed, fell back below that level, and struggled for a couple of days. So right now, the whole thing is up in the air, frankly. The bulls failed to capitalize on that, and a negative breakout, or a breakout that's reversed so quickly, can lead to problems. Now, admittedly, the market had gone up quite a bit in the 2 weeks before that, so any kind of little pullback is not real cause for concern. But right now, there is resistance at those highs up there around 46.37 that were set last week. Meanwhile, on the downside, 44.20 seems to be an area that should hold any declines here. If it doesn't, then we might have bigger problems on our hand. And of course, there's major support down there, 4,100 to 4,200. So right now, the S&P chart is, well, sort of neutral. I wouldn't say that it's either bullish or bearish at this point. If it can break out higher than last week's high, then that would be a bullish factor. The equity-only put-call ratios, however, are very bullish. In fact, they're our most bullish indicator. They've continued to drop. There was a little wiggle in the one ratio last week, but on Friday they were both at their lows since, quite a few weeks ago, and that's a positive thing. So as long as those ratios are dropping, that's positive for the stock market. On the other hand, market breadth continues to be a problem. Last week, saw heavy negative breadth on the sell-off, then a little bit of recovery on Friday. So technically, right now, both our breadth oscillators are on buy signals, but just barely. Any day, one day of negative breadth is going to push them back to sell signals. We're not relying too heavily on them right now. They've been rather wishy-washy this year. A lot of whipsaws on those signals. New highs versus new lows have improved, and last week we did get a buy signal from that indicator based on New York Stock Exchange data. That's still in place. However, NASDAQ data and stocks-only data, which encompasses a much broader range of stocks than just the New York Stock Exchange, those are both still in a slightly negative state. So while the number of new highs is improving, it's not outrageously positive yet, but just modestly positive in terms of New York Stock Exchange data. So that brings us to the volatility complex. Now, we had a VIX spike peak buy signal in place, but it has expired. So that's no longer helping the market out right now. So what we're looking at on the VIX chart is the comparison of the VIX, its 20-day moving average, and its 200-day moving average. So VIX is below its 200-day moving average now by just a little, and that relieves the negative intermediate-term sell signal that was in place. However, there won't be an intermediate-term buy signal in place unless the 20-day moving average of VIX also crosses below the 200-day, and that is not imminent. Finally, the construct of volatility derivatives has turned fairly positive. The VIX futures are trading at a big premium to VIX, and their term structure slopes upwards. Also, the term structure of the CBOE volatility indices slopes upwards as well. So that's a positive indicator. All in all, we don't really have any sell signals in place right now. The intermediate term indicators seem to be a little bit in question. So we have our short-term indicator signals, some of them still in place. As I said, the spike peak buy signal has expired, and we are trading those on a daily basis. So I invite you to visit our website, take a look at the newsletters that we have that cover these things, and meanwhile, have a great week trading.